to present a case study about First Farm Corporation. First Farm Corporation has grown to become one of the Philippines' most respected integrator and feed producer. Later, it expanded its service to include fresh and freshly frozen food production, allowing it to serve a large number of Filipinos around the country. The history of the First Farm Corporation may be tracked back to the 1950s, when Brother Francisco Joselito and Arturo Evangelista established a modest animal feed production plant in Caloocan with only 15 employees. Back in 1990s, they saw unusual robust growth with revenue increasing by more than 20% each year, net income and on return on equity increasing by nearly 50% per year, which is a good thing. 1994, fresh and frozen chicken, processed meat, animal health products, and feeds were among the company's product categories as of 1994. It boasted a workforce over 1,700 people and was known as the country's leading chicken integrator. In February 1995, First Farm Corporation went public, raising 1.5 billion pesos by selling 25% of its outstanding common stock to the public. The corporation had a boom year at this year, with combined sales of 5.7 billion, up to 44% from the previous year's performance, which is a good thing, and the net income of 280 million, up to 89%. Here is the next part.
Okay, let's now proceed. Our case analysis aims to determine the following. First, despite a 44% growth in sales and an 89% increase in net income, what caused the First Farm Corporation to have a negative operational cash flow and a lower on return on equity in 1995? Second, how can the company's return on equity or the ROE be risen?
Third, given the operation and market issues such as decreasing chicken prices, increasing production costs, and bottlenecks in its chicken industry, what action should Mr. Ricardo propose to the next executive committee meeting to strengthen the existing plans and financial situations such as working capital? Fourth, will approving manufacturing facility expansion proposal increase sales and profitability for the company? To explain the answer, let's proceed to the next reporter.
Industry analysis. First, industry rivalry. In this sector where demand in the Philippines is continuously increasing, the industry also has big competitors and rivalries. For instance, one of the biggest competitors in the industry is said to be Marigold Food Incorporated. Bargaining power of buyer. Since competitors are present, quality and prices cannot be overlooked with respect to the market and consumer interest. Local manufacturer and competitors are actually just a portion of the industry rivalry. Third one is threat of new entrants. As the government imposes the entry of imported goods, frozen poultry, specifically chicken, it is currently undermining the control of the local agribusiness. Since the goods and frozen chicken are cheaper than the local ones, the market will more likely choose this as an alternative. This new entry poses a threat to local poultry and business. The fourth one is threat of substitution. Substitutes are present in the market and their prices can be the reason why the consumer will or may shift to this substitute. For instance, poultry can be substituted by other meat or white meat. What for First Farm Corporation? Strength. The company was rapidly growing with revenues increasing by more than 20% per year and ROE increasing by about 50% per year in the 1990s. Also multiple product lines such as fresh frozen chicken, processed meats, animal health products, and feeds. The weaknesses is that most of the company's inputs of raw materials are prone to price increases, which cause the increase in cost of production. The company venture on the product lines with the tight competition that constrain the price of the products. The opportunities is that increasing demand for their new product line, like aqua feeds. Lower tariff for exporting chicken would mean a market opportunity for the business. And the threats are there is no assurance that the demand of the product and the sale will increase given the industry supply glut. And the other threat is that cost of corn, soybean meal, and fish meal have been rising, thus increasing the cost of production. Risk analysis. There are many risks that may arise, such as having an outbreak, disease, or infection, which may occur when a flock had an exposure to the disease and spread it on all the chicken. Next is the feed cost, which is challenging in terms of providing a continuous, high-quality feed. And lastly, the lack of supply that may affect the production or the operation of the business. It may not avoid this risk, but it may resolve this in some way that we have to be knowledgeable not only in producing but also in improving skills and having alternative ideas.
Thank you, Maurice. So moving on to the cash flow analysis, in spite of the fact that net sales and net income increases every year, the statement of cash flows shows that there is a deficiency arising in its operating cash flows, which is also heavily financed by new investments, although the company is expected to grow rapidly. For example, in this chart, as you can see, the cash flow adequacy ratio shows an insufficiency result of the company to pay its ongoing expenses due to its rate that is lower than 1. On the other hand, the long-term debt ratio tends to rise as the year moves forward, meaning the business is becoming more dependent on its debt. The negative result of operating cash flows made FFC to use capital stock subscriptions to subsidize its capital expenditures. In short, First Farm's cash flow indicates an unhealthy financial position because the standard of a healthier financial position has more cash that flows within the company.
Let's now proceed on the analysis of the balance sheet. On 1993, it is showed that the inventory was 584,400. On 1994 was 702,429. And during 1995, the inventory increases into 1,505,746. It shows here that every year, the number of inventories is increasing each year. It just means that the production of goods is increasing every year so that the company is growing. Now, let's now proceed to the account receivables. By 1993, 180,887 was the recorded accounting receivables. During 1994, 293,307, and during 1995, it increases by 474,200. Let's focus on the efficiency ratios. The total asset turnover ratio during 1993 was 1.72. During 1994, it was rated up to 2, and during 1985, it decreased by 1.46. The account receivable turnover ratio was 14.19 during 1993, 11.35 by 1994, and 7.65 during 1995. It just said that the company can collect their account receivable that easy, that faster. Like it is said here that the average collection of the account receivable it can be collected by 25.38 days on 1993, which is, it can be collected by less than a month. But then, during 1994, it said here that 31.73, which is the receivable was hard to collect. Like it increases almost one day in a month. But in 1995, it also increases. It increases more than half month days. It turned out 47.3 days to collect the receivables. Let's now focus on the ratios. The first one is the profitability ratios. The net profit margin was increased during those 3 span years. The return on investment was also increased. The return on asset was decreased by 0.21 into 0.16 during 1995. The return on equity was increased. Let's now focus on the liquidity ratios. The current ratio during 1993 was 1, but it continued to be consistent during 1994, and during 1995 it increases by 0.35. The quick asset ratio was 0.1, then it decreased into 0.09, but then it increases during 1995 into 0.17, which is a good thing. Lastly, the leverage ratios. The debt ratio was 0.62 during 1993, 0.65 during 1994, and 0.54 during 1995, and it shows here that it decreased. The equity ratio was 0.37, turned into 0.35, but then it increases into 0.46 in 1995. The debt to equity was 1.67, grow into 1.82 during 1994, but then it decreases 1.16 during 1995. The interest coverage ratio was 1.37 during 1993, 2.15 during 1994, and 11.88 during 1995, and it's obviously increased.
The income statement of the First Farm Company over the production period resulted in company's more profitability. It indicates that the company net sales percentage growth. The company gained a net income of 89%, was about 280 billion, due to the consolidated sales from taking leadership from their competitors. The company came up with an increase in the net sales from 1994 with 1.1 billion or 37% to 1995 with 1.7 billion or 44%. An increase in the cost of sales and other operating expense in 1994 with 35% and in 1995 with 45% was due to the rising cost of corn, soybean meal, and fish meal. The decrease in interest expense of 69% is from the interest loan of the company. In this outcome, it indicates that the company paid more interest loan. The decreases in interest expense resulting in an increase in income before taxes. The lower interest expense rate thus results in higher income tax expense. In the year 1994, the interest expense decrease of 16% came up with increasing rate of 97% of income tax expense. However, the year 1995, the interest rate decrease of 69%, thus resulting to increasing 48% in income tax expense.
First Farms Corporation is an animal feeds manufacturing company expanded to other agribusiness products and nationwide facilities. FFC raised 1.1 billion pesos in its initial public offering in 1995. The proceeds were split as follows. 500 million pesos went to working capital, which includes livestock inventories and raw materials. 476 million pesos to expansion and property purchase, and 69 million pesos to pay down some of the corporation's long-term borrowing. The company also secured the rights to construct and operate California Chicken and Gulliver's Chicken restaurants in the Philippines in the same year. According to the company's SWOT analysis, despite the company's strengths and limited internal weaknesses, it is not advisable to continue expanding because some macroeconomic and external factors are primarily outside the company's control, limiting the company's potential profit growth and expansion. The expansion will enhance FFC's production capacity, it will exceed the profit, and market demand is predicted to grow. But due to severe rivalry and overstock in the industry, there is still uncertainty in the increase in sales and net income. And growth in the demand and production cost can also make the price to increase that will make the purchasing ability of customer to lessen. If the expansion is allowed, short-term debts will be used to fund it. However, despite a slight improvement, the company's liquidity indicators and negative operating cash flow shows that it is not in good shape when it comes to repaying short-term debts. Likewise, utilizing long-term obligation to fund a project is not encouraged due to insufficient leverage. Furthermore, the group argues that supporting long-term initiatives with short-term debts is a bad idea. Also, higher borrowing costs will increase the company's interest expenditures.
First Farms Corporation's increase in sales and net income but deficit in operating cash flow and decrease in return on equity is recommended to venture into activities and policies that would improve the situation. It is not a good indication for profitability control, efficiency, and leverage that there are disproportion between ratios. FFC is recommended with the following courses of action. First, review the system of collecting policy for the company. This recommendation may help the company assess their liquidity ratios through reviewing the collection policy period. The company may improve it and even the account receivable turnover ratio, in which will help make the cash on hand increase. This may improve liquidity ratios of the company, and in improving the collection period of the company, it can be helpful for them to assess the flow of cash and even the return on accounts receivable. Next recommendation, assess the company's inventory and turnover period. If the company will review the inventory and turnover period, they can assess their flow of income and improve return on equity. The increase in the company's average turnover period directly affected the cost of sales of FFC. Thus, inventory moved slowly, which also indicated an increase in the cost of their products. The company is recommended to lower down the inventory turnover period that will also give impact to the income and ROE of the company. Third, analyze other macroeconomic factors significant for price increase. Macroeconomic factors are those indications from outside environment of the company if they can assess price increase that will result to profit. It is recommended for FFC to consider the macroeconomic factor which affect the increase of prices. This analysis may assess the company if the increase in price is helpful for profitability or not, given that there are various macroeconomic factors, and if the product of the company will give advantage for the company's market demand and supply. Lastly, evaluate alternative sources for assessing inputs. It is recommended that the company seek for other sources for their inputs of products. This way, the company may find a lesser cost of producing those inputs. Therefore, alternatives may help lessen the cost of producing inputs. As an analysis, these are some of the possible recommendations for the First Farms Corporation to improve its return on equity and its profitability or cost control. Thank you.